Well, there are two primary tools you can use to plan your use of cash in your business. The first is financial reporting, and the second is cash flow reporting and planning. And that's what we're going to talk about now. There are three financial statements that are key to your keeping track of your numbers, and you should be familiar with all of them. Your balance sheet tells you the value of your business at any one particular point in time. Your income statement gives you the financial results of your company during a particular period of time. And your statement of cash flows tells you where your company's money is coming from and how it was used during a particular period of time. Now, my experience is that most business owners are fairly familiar with the income statement, comfortable with most aspects of their balance sheet, and generally don't know what to do with the statement of cash flows. I don't want to spend a lot of time today going over all three of these documents, but since we're talking about cash flow, I think we should spend a little time talking about that one report, the statement of cash flows. Now, it's important to look at these reports because they give you information about two time frames for a particular activity, historical and future. You need to understand fully how your company has operated in the past during whatever period you're looking at, whether that be monthly or annually. But you can't drive a car by looking in the rearview mirror. You need to look at what the future might bring as well. So to look at historical usage, how your company has used cash previously, we need to look at that statement of cash flows. Where did you get the money that you've used over the past period, whatever period you might be looking at, and where did you spend it? How actively you look at your bank balance or your credit line usage, that will tell you something about the cash that you have available. But other than looking at the expense side of your income statement, do you really have an understanding of where your money came from and where it's been spent? And there's another report, a planning report, that's just as important. It tells you where you can expect to spend your money over the coming weeks or months. That's your cash flow forecast. Now, this is something that you're going to need to create. It's not something that your financial software is going to be able to make available for you. You will need to predict how you're going to manage your business over the next 13 weeks or even 6 months. And that's even more important for you because this will allow you to do some planning. And because it's better for you to know that you're going to be short of cash for payroll in 6 weeks than it is to suddenly find out that you don't have enough money to cover payroll this coming Friday. So here's an example of a sample cash flow statement, a statement of cash flows. Remember that this is a display of the cash side of your business. There's no accruals here. This is really displaying the money that went into your business and out of your bank account. What you want to see is where that money came from and where the company used it. So let's look at each section of this pretty quickly just to see how this shows you the historical use of money in your company. So you start out looking at the beginning cash. This is the amount of the company's bank account at the end of the prior month. Add to that the net income that they've earned in the company over this past month. And we also add back depreciation since it's on the income statement. But depreciation is a non-cash expense that's deducted from gross margin along with all of your other expenses to result in operating income. So we add that back in because it has nothing to do with the amount of cash that the money made this past month. The next section tells you where the changes are in cash that result from business operations. You can see that the total line is shown as cash provided or used in operations. Here we're looking at the changes in the value of major balance sheet accounts. Each one of these is impacted by either spending money or not spending money in each one of these accounts. If the number is in parentheses, that's because they spent more money than they took in. In the case of AR, for instance, the number has decreased because you collected less money than you billed out this past month. Now that's a good thing for the future, but that has an impact only on future cash, not on cash this month. Inventory value grew as well, but that's because they spent more money to buy inventory and they bought more inventory than they used. In accounts payable, they paid fewer bills than they entered. So they used less cash, which resulted in an increase in working capital. The net result of all of these adjustments was a decrease in cash availability of $211,000. Now we move on to investments. Well, really, this isn't an investment like investing in the stock market, but it is cash invested in the business. In this particular case, it was $26,137 that was used to pay for capital equipment that had been purchased previously. Remember, we're looking at this on a cash basis, so this $26,000 is a payment that was made. Under financing, they borrowed money from the bank. This was an increase in their use of their line of credit. It seems that there are really two loans here. One was paid down by $13,233, and the other was cash drawn out of the credit line to the tune of $158,081. The net change was an increase in cash available to the business of nearly $145,000. So here it is, the conclusion. They ended the month with $11,208 in the bank after starting the month with $103,791. Now, if there's one thing that's most notable, it's that in spite of the fact that they had net income of $160,000, they lost over $92,000 of cash availability. They only have $11,000 available at the end of the year. At the end of the month, because they borrowed $158,000 from the bank. Now that's the lesson to be learned here. It's not net income that allows you to run your business every month. It's cash flow, cash availability. So let's look at how the company did last month. It's a good start to understand why you need to do a cash flow forecast, because you want to plan ahead so that this doesn't keep happening to you. If every month you had to borrow $158,000 from the bank to stay afloat, as the company did this month, you wouldn't be floating for very long, now would you? So let's look at how you plan for cash that you can spend.